Right now, Expedia stock, ticker EXPE, is trading live at $258.39. That is a massive move, an explosive gap up of $38.69, or 17.61% on the day. The stock opened at $247, immediately shot up, and has just hit a new 52-week high of $259.79. The volume is enormous. Over 3 million shares have already traded hands, which is nearly double the entire daily average, and we're not even at midday. This is not a drill. This is a major high-conviction re-rating of the company happening in real time. And the immediate insight, the one thing you must understand, is that this explosive price action isn't just because people are booking more beach vacations. The market is scrambling to catch up to a reality it completely misjudged. While most investors, perhaps checking their accounts on the Robinhood app or looking at SoFi Invest, have been conditioned to think of Expedia as a simple consumer website, the real story that just dropped is about its dominance as a business-to-business technology provider. The consumer side is strong, but the B2B segment just reported a staggering 26% growth in bookings. That is the engine under the hood that analysts missed, and it's forcing a complete recalculation of the company's value. Let's establish the common ground, the expectation that was baked into the stock price as of yesterday's close. The prevailing narrative across the market was one of caution. The consensus belief was that the post-pandemic revenge travel boom had peaked. With persistent inflation, higher interest rates, and worries about a consumer slowdown, the expectation was that discretionary spending, with travel being at the top of that list, was about to fall off a cliff. Analysts were lukewarm. Just look at Piper Sandler, who held an underweight rating on the stock, fundamentally betting against it. They, like many others, were worried about tough year-over-year comparisons and intense competition. The market was braced for a miss, or at the very least a gloomy outlook for 2026. That was the expectation, a cyclical travel company heading into the downward part of the cycle. Then last night, reality hit the tape. Expedia reported its third quarter 2025 earnings, and it didn't just beat expectations, it fundamentally dismantled the entire bearish argument. The adjusted earnings per share came in at $7.57. The analyst consensus was stalled out around $6.95. That's not a small beat, that's a blowout. Revenue hit $4.41 billion, crushing the $4.28 billion estimate. But the most critical piece, the part that is causing this massive influx of buy orders today, was the guidance. Management didn't just hold the line, they raised their full-year revenue growth forecast from a modest 3 to 5% range to a much stronger 6 to 7%. They announced a new, more aggressive share buyback program, and they stated that room night growth in the United States just hit its fastest pace in over 3 years. This wasn't a company struggling with a consumer slowdown. This was a company accelerating. This is the kind of move that sends institutional traders scrambling to their interactive brokers platform to cover short positions and get long, fast. The volume tells you everything. When you see nearly double the average daily volume before lunch, that is not retail traders doing self-investing. That is the footprint of major funds, the Fidelity Wealth Management and Schwab Intelligent Portfolios of the world having their models proven wrong and being forced to buy. They are reallocating capital. This is what a thesis-breaking event looks like on a stock chart. The stock is breaking out to a new 52-week high, and it's doing it on volume that confirms the move is real. This isn't a low-float anomaly. This is a blue-chip re-rating. Let's dig deeper into the why of this move, beyond the headline numbers. The true reality of the new Expedia and what the CEO Ariane Gorin hammered home on the earnings call is the power of their two-sided model. We all know the consumer-facing brands, Expedia.com, Vrbo, and Hotels.com. That's the B2C segment. It grew bookings by 7%, which is healthy, but the B2B segment, Expedia Partner Solutions, is the real story. This is the division that provides the back-end technology, the inventory, and the booking engine for thousands of other businesses, from major airlines and hotel chains to smaller travel agencies. This segment, as mentioned, saw bookings rocket up by 26%. This is its 17th consecutive quarter of double-digit growth. This is a sticky, high-margin, scalable technology business hiding inside a travel company. The market was valuing EXPE as a simple online travel agency, subject to the whims of consumer spending. The reality is that it's also a critical B2B software provider that is steadily taking market share. This provides a level of stability and growth that isn't present in, say, the highly volatile Tesla stock or even other large-cap tech names. This earnings report forces a reevaluation of the entire travel sector. While investors have been piling into Nvidia stock looking for growth, here is a boring travel company expanding its margins and raising its full-year guidance. This report single-handedly challenged the macro narrative of the dying consumer. In fact, management specifically noted that travel demand remains strong across all income groups, not just the wealthy. People are prioritizing travel, and Expedia is executing to capture that demand. This is why you're seeing analysts who were bearish just 24 hours ago, like Piper Sandler, come out this morning, completely reverse their position, and upgrade the stock, raising their price target from 190 all the way to 250. Wells Fargo followed suit, boosting its target to 272. This is what capitulation looks like on a stock chart. So, what does this company actually do? For those who only see the commercials, Expedia Group is a massive online travel conglomerate. Its B2C segment is its public face, an online investing site for trips. It operates core brands like Expedia.com, which is a full-service agency, Vrbo, which is its direct competitor to Airbnb and vacation rental space, and Hotels.com, which focuses on accommodation. It also owns Trivago, which is a meta-search engine. This is where most people using an individual brokerage account would have their online investment thesis focused. But the B2B segment, Partner Solutions, is the strategic weapon. It leverages the company's massive inventory and tech platform and sells it as a service. This diversification is a key advantage over competitors who are purely B2C. The company's new One Key loyalty program is also a critical development, designed to unify these brands and drive repeat, direct bookings, which are far more profitable than traffic acquired through expensive search engine marketing. Looking at the past, the stock has been on a wild ride. It was, of course, decimated in 2020, then saw a massive recovery. But for the last year, it's been choppy, trading sideways as the market tried to figure out if the growth was sustainable. Many investors looking for investment help might have seen this as a show-me stock. Well, last night, Expedia showed them. The platform-wide tech migration they completed, which caused some disruption, is now clearly paying off. The new unified tech stack is allowing them to innovate faster, integrate AI-driven features more effectively, and improve conversion rates. This isn't just a simple online investing play anymore, it's a bet on a unified technology platform. This is the kind of fundamental shift that long-term investors using Fidelity brokerage services or analyzing Fidelity mutual funds look for. It's a change in the core story. Now, let's talk about the future outlook. What are the catalysts and risks from here? The primary catalyst is the continued compounding growth of that B2B segment. If it can maintain anything close to this 20+% growth rate, the stock is still too cheap, even after today's jump. The second catalyst is the One Key loyalty program. If this program successfully builds a moat and shifts customers to booking directly, it will dramatically improve margins. This is a long-term positive that many SoFi active investing users should be watching. The third catalyst is AI integration, which the company is using to personalize travel planning and improve customer service, further reducing costs and boosting conversion. The risks, however, are still real. The primary risk is macroeconomic. While the consumer has been resilient, a genuine, deep recession would eventually hit travel bookings. That is unavoidable. The second risk is competition. Booking.com, BK is a fierce and exceptionally well-run competitor, and Airbnb dominates the alternative accommodation space. Vrbo is a strong number 2, but it's a tough fight. And there's always the ever-present risk of Google, which continues to push its own travel search products, potentially siphoning off high-margin traffic. Investors using Fidelity ETFs to get sector exposure might be buffered, but individual stockholders need to watch this. Before we conclude, I want you to comment below with your thoughts. This is a massive move. Comment below, do you think this B2B growth is sustainable, or is this a one-time surge from post-platforming tailwind?